Okay, IFRS 15, revenue from contracts with customers. We started now. Scope, it applies to all contracts with customers, except, let me correct it, lease contracts, IFRS 16, except IFRS 16, because if you have some revenue from leases, it is treated under IFRS 16, insurance IFRS 4, or IFRS 9 financial instruments, 39 is gone, IFRS 10, 11, IS 27. So IS 27 is for consolidation. You've got now IFRS 10 here. This IFRS 10 and IS 27 were related. IS 28 is also consolidation, equity accounting, IFRS 11 joint arrangements, IFRS 9 financial instruments. So the scope is, these standards are not within the scope. Certain non-monetary exchanges, it also does not apply. When we say revenue, actually, primarily when we say revenue, we are talking about the goods and services provided in the ordinary course of business. In the ordinary course of business. Ordinary course of business means that what is your core activity. So remember, in your P&L, in your income statement, the first line is called revenue. And what do you write down in revenue? In your revenue, you only include the economic benefit which you are receiving by providing the goods and services, which is in your ordinary course of business, which is your core activity, which is your core activity. Core activity means that if you are a construction company, every time you earn some revenue by completing a construction contract, it comes here. If you are a furniture manufacturing, or if you are a furniture selling company, showroom, every time you manufacture or sell furniture, the benefit you receive, it comes into revenue. And you should remember that the revenue which we write down in our P&L, in our income statement, it is based on accruals principle. Accruals. Now, this is not accrued income. I'm using the word accrual. Accrual means that whether you have received the money or you have not received the money, you record the revenue, provided that you have delivered the goods, provided that you have delivered the services. So as soon as you deliver the goods, or as soon as you deliver the revenue, and there are certain conditions which I'm going to discuss, and the client receives the goods or client receives the services, client might pay you 3 months later, but you immediately record it into revenue. And this is where the problem, it happened that we recorded revenue a lot, which we have not received in cash, but we have inappropriately accrued that. So this comes under revenue, the first line. And of course, you might have some other sources of income. Those go to other income or other comprehensive income. But in revenue, only your core activities will come in. Definitions we need to learn under these standard. A contract is an agreement between two or more parties that creates enforceable rights and obligations. Customer, a party that has contracted with an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration. So when we say consideration, it means that it could be in cash, or it could be in kind, which means that not cash, but some other thing. So you provide some services to someone, and in return, they also provide some services, or they give you cash, or they give you some other assets, or they, reduce your liabilities. Anything can happen. So consideration should be there. And ordinary course of activity, which is your core business, core activity between the two parties. Revenue, income arising in the course of an entity's ordinary activities. Ordinary activities means that what the company is supposed to do. Income, now this is the definition we discussed in our conceptual framework, income and expenses. If you remember that any transaction which would result in increase in equity, or which would increase the equity other than the capital transactions, other than the capital injections. Those are called income. Standalone selling price. Standalone selling price. Now, there are few terminologies which we will learn here. One terminology, we say point in time. And one terminology, we say period of time. So generally, goods are in point in time, and services generally are over a period of time, which means that whatever are your core activities or your ordinary course of business, when you sell goods or you provide services, so it is possible that goods, when you deliver the goods, the obligation is finished, you have transferred the goods, and it is one point in time, in one day, in 1 hour, in one moment, and you can record the revenue for you because you have given the goods. I mean, I go somewhere or somebody comes to me, I sell, you know, I don't know, shoes, or I sell these shirts. So somebody comes in, he gives me $50, I give him the shirt. It is called point in time, done. This transaction will not continue for a longer period of time. He comes in, he checks the shirt, he asks me the price. I said it is $50. He negotiated, we agreed on $45. I give him the shirt, he gives me the money, transaction is done. You can record the revenue. But sometimes there are some sales, there are some revenue, which is especially from services, which is over a period of time. Over a period of time, where you are getting the money today, but then you do not deliver everything today. You deliver it for a period of time. For example, you know, rental contracts. So I give a 6 months, I give a 6 months rent, okay, 6 months rent in advance. So I pay the rent here, but I'm going to consume this service in the next 6 months. So income is accrued over a period of time. Or maybe sometime you purchase cars or you sell cars, and cars come with warranties. So a car with 3-year warranty. So if you consider that a car which has a price of 30,000, and then they say that it includes 3 years warranty, there is a 3 years warranty inside. And of course, during the warranty period, they provide the service. So inside of this 30,000, it's a package deal. It includes this 30,000. It includes 2 items. One is the car and one is the service. Car is 27,000, let's suppose, and service is 3,000 for 3 years, let's suppose. This one is point in time. This is in point in time, and this is in period of time. This is called period of time. You can record this revenue because you already have delivered the car, but you cannot deliver this revenue because you have not delivered the service now. So customer pays 30,000. Usually what we say debit cash, 30K because we received cash, credit revenue, which is the revenue from the sale of car, is 27, and credit deferred revenue. Deferred revenue is called advanced revenue. It is a liability, and that you debit it with 3,000, because for this 3,000, it is a liability thing, because you have received $3,000, but you have not provided the service. You will provide the service within 3 years. So at end of every 1 year, you will record this 1,000, 1,000, and 1,000 revenue. Here you will only record 27,000 because 2 things were there, car and service. Car was delivered and the revenue which was related to car should be recorded, 27, just like I recorded. But this is the service for the next 3 years. So let's suppose that it happened on 1st of January, and then I sold the car and I booked 27 only in revenue, and I booked $3,000 in my deferred revenue, which is a liability. Then on 31st of December, when 1 year will finish, and I already have provided 1 year of service, and the customer has consumed 1 year of service, now some portion of that revenue I can recognize. I would say now debit deferred revenue. So this deferred revenue, before I made it a credit, which was a liability, now I make it a debit, 1,000, and I would say credit revenue, 1,000. Now 1,000 will go to my revenue, and 1,000 will be reduced from my liability. And the same transaction will happen next year. The same transaction will happen next year. So this 3,000, the service revenue, you record it over a period of time. So the point here to explain you, and I'm going to discuss it in more detail. I will go back to Excel. We will pick up some scenario and we will understand it in more detail. What I'm doing here is I'm giving you an overview that you need to see that the revenue which you are going to recognize, is it a point in time revenue or is it a period of time revenue? Point in time usually belongs to products, and period of time generally belongs to services. And because you have delivered the car, your obligation in relation to the car is finished. You have given the key, you have handed over the car, the customer has checked the car, customer has taken the delivery of the car, and the customer has paid you 30,000. But 30,000 is more than the car because car was only 27. Remaining 3,000 customer gave for service. And as he will receive this service in next 3 years, accordingly, you will record the revenue 1,000, 1,000, 1,000 in the next 3 years. Okay, so now we come back to the concept standalone selling price. Now this is, I already have explained to you. Now what is standalone selling price? Standalone selling price means that sometimes you have some products or some deals which have multiple components. Just like I said, that $30,000, the car, in this, there was car and there was service. And this is called standalone price of the car, which means that if I purchase the car in the market, how much it is for? Maybe the car is for, I don't know, 28,000, let's suppose. If I purchase the service, 3-year service, not the car, ignore the car, I only want to purchase service, warranty, maybe it is for $4,000. So this is called standalone price. This is called standalone price for the service, but together you negotiated with the customer because otherwise it makes 32,000, but you negotiated with the client on $30,000. So these are the standalone prices, and this is the joint price which you have agreed. So we need to understand standalone price. Why do we need? We will do some question. The price at which a good or service would be sold separately to a customer, separately to a customer. You know, it could be not only about car, okay? Let's suppose that you are asking someone to renovate your apartment, okay? To do renovation of your apartment. And the renovation includes, you know, wallpapers. It includes flooring. It includes ceiling and includes lighting. So these are the 4 things I want someone to do. So if I ask someone to come and fix or put the wallpapers, they say, I'll take $1,000. For flooring, somebody else says, I'll take $2,000. For ceiling, it is $1,000. For lighting, it is $500. So if you see them, these are called the standalone prices. We say the price at which good or service would be sold separately. But then we made a deal with someone that I will give a contract to some party, you come in and I agree with them $4,000. So there is clearly a discount of 500 because if you see them total, it makes 4,500. So this is my package deal for 4,000. Standalone prices are these ones. So we need to understand the terminology standalone price. And then this is the first time a new terminology was introduced, performance obligation. This word was, it did not exist in the old standard IAS 18 or IAS 11. So, I mean, you know, every time we are becoming familiar with new technology. You are in IT, we never heard about Android. We never heard about Bluetooth like 20 years ago. So now we know what is Bluetooth. That was an addition to our vocabulary. Then we started hearing about words. Okay, there is something called Wi-Fi. There is something called ADSL. I don't know. In IT, you've got different terminologies. So similarly, in accounting, some terminologies are coming new. So this terminology, performance obligation, it first time came with this standard IFRS 15. Performance obligation means that your contract, what you are promising to deliver. For example, when I say that somebody comes in and renovate my flat or renovate my apartment, what were the obligations inside? We call it performance obligation. So what do you promise to do? I'm going to renovate your flat. This is a very vague term, but what happened that previously under IS 18, now this is now very interesting, under IS 18, you only made a contract with someone to renovate your flat. Please listen to me carefully. Listen to me carefully. You made a contract of 2 pages between myself, Ali, and someone else, maybe, X, whereby Ali and Mr. X, they agree that Mr. X would come and renovate his flat, which is, I don't know, 150 square meters. And he would do lighting, flooring, ceiling, walls, and Mr. Ali would pay 4,000. That's all. This is what it was written before under IS 18. But now under IFRS 15, we write down separately that, lighting is for 500, flooring is for 200,000, ceiling is for 1,000, and wallpapers is for, I don't know, again, 500, which makes it total 4,000, let's suppose. So you mention, now these are called separate performance obligations. Under IS 11, under IS 18, there was one performance obligation. There was one performance obligation to renovate the flat for $4,000. But now under IFRS 15, we have 4 performance obligations: lighting, flooring, ceiling, wallpaper, and we show them separately. So before it was one obligation for 4,000. Now there are 4 obligations, and each obligation is shown separately on the contract. So you see that manipulation is not possible. Somebody could come in and say that 50% of the work is done. Let me recognize 2,000 as revenue. Now you say that, okay, this is done. You can recognize. This is not done. This is not done. This is not done. You cannot recognize because you have become more specific. You have become more accurate. You have broken down the contract, one contract, into 5 or 4 or maybe 10 or maybe 15 performance obligations separately. And each performance obligation, you have mentioned the separate price. So manipulation is not possible. Before, when you were making the building, so, large building construction, a building contract is for $20 million and it has 10 activities to be done. Digging the foundation, making the structure, doing the front facade, then doing the internal fittings, flooring, ceiling, lighting, heating, windows, doors, electricity works. So many things under 20 million. Before, not everything price was given separately. So you said that, oh, this contract has been completed 30%, let's book 60 million revenue. And that was a very, very rough way of doing it. That was a very vague way of doing it. Of course, we did have third-party surveyors because this 30% must be approved by some third-party surveyor who would come in. But again, the third-party surveyor was also not able to do it accurately because you never mentioned that what 20 million consists of. Now what you are doing, you are breaking down the one contract into different performance obligations. We say a promise to transfer to the customer either. So what is a performance obligation? A distinct good or service, a distinct good or service, a series of substantially the same distinct goods or services. So we call it series of substantially the same distinct goods or services, goods or services. I mean, for keeping it simple, let's suppose that we are doing this IFRS training for which there is X amount of revenue, which you guys are committed to pay. And this actually is one course, but then it has 16 lessons, let's suppose. So series of substantially the same goods or services. So one lesson, second lesson, third lesson, fourth lesson, fifth lesson, sixth lesson, and so on. So either you deliver it once or you keep on delivering it over a period of time. So 5-step approach, this is the basic model of IFRS 15. The basic model of IFRS 15, of course, it was not present under IS 18 or 11. The previous standards did not have it. So 5-step model, you need to remember 5 steps. It's very easy. Number 1, identify the contract. Do we have a contract or not? And if we have the contract, it is between which parties? So number 1 is, preparation of the proper contract. Number 2, identify the performance obligations. So this is the main contract. And then what are the performance obligations within the contract? Okay. So, flooring and ceiling and lighting and heating and whatever. So first step is make the contract. Second step is divide the contract into subsections, which are called performance obligation. Number 3, determine the transaction price. What is the transaction price of the overall contract? It is, 4,000. The renovation of the flat. And step number 4, allocate the transaction price to each performance obligation. So what we did before, we said that how much is the contract for? The contract is for 4,000. And then this 4,000 belongs to different performance obligations. This is 500, this is 500, this is 1,000, this is 1,000, and this is 1,000. So you split it. So this is step number 4. And step number 5, recognize the revenue as each performance obligation is satisfied. So, okay, we have done the wallpapers, we can recognize the revenue. We have done the, lighting, we can book the revenue. We have done the flooring, we can book the revenue. Ceiling is not done, and something else is not done. So we cannot book the revenue. So 5 steps. Number 1, identify the contract and identify the performance obligations within the contract. Now, that could be a tricky part, by the way. Identifying the contract is easy. This thing is complicated. Step 2, because there might be a question that how many performance obligations do we have? 1, 2, 3, 4, 5, or maybe 30. So if I have a contract of a big building, let's suppose I was here talking about a small apartment. Let's suppose it's a big building. And of course, in a building, there is much more work to do. And the value of the contract is 20 million. So how many performance obligation do I have inside? 5 I should make, 5 performance obligations, maybe 10, maybe 15. How many? Because I don't want to be too complicated, and I don't also want to be inaccurate. So I have to keep a balance between accuracy and complexity. Because if you start saying, oh, I'm going to make 100 performance obligations, every little thing is going to be a separate performance obligation, you will make your life very difficult. 100 performance obligations probably would bother you a lot. So you say, okay, let's move to simplicity. And if you come to simplicity of making 10 performance obligation, you might lose accuracy. So you need to somehow stay somewhere in between what is the most appropriate number of performance obligations. But before you decide on the number of performance obligation, you need to understand that what could be a performance obligation. what could be classified as a performance obligation. So I tell you, remember, the rule is any activity which you perform or which somebody performs for you, which could be consumed or used or get benefit by the client. If the client can get benefit out of it, if it can be used separately without some other thing, if it can be used separately, if it can be sold to someone, it can be used by someone, if somebody can somehow get benefit out of that activity, it is called performance obligation. Now, you might not be very much clear about what I said, so I'll explain you with the help of some example, but let me repeat it again, that a performance obligation could be that activity. So I'm giving you a general principle so that in future, whenever you face the situations, you have to make your own judgment. So remember that a performance obligation could be any activity from which someone can sell it to someone, which someone separately, which someone can use it separately, or they somehow get benefit from it separately. And how do they get benefit in future also possible? For example, let's start like this. Now I'm going to give you many examples because that's very important area. What could be a performance obligation? So the first thing in this building was digging the foundation, okay? Foundation work. So foundation work means that somebody will come in, they will dig the foundation, probably they will go deep 5 meters, 6 meters, maybe 10 meters, if you are making a parking lot underground or whatever. So you dig the ground. So you invited me that come and dig the ground, and I started digging, and then you say, stop. I don't want to continue further. We don't have funds. We have changed our mind. Let's stop the work. So if I stop the work, of course, you should be paying me for this because this is going to give you some benefit. Because in future, whenever you will try or whenever you will resume your production, whenever you will resume your construction, you will start construction again, you don't need to dig it again. This digging, which I have done already, it will benefit you for your future. When you will start your construction project, you don't need to do it again. It's a performance obligation. You can get benefit out of it. Okay, now that's a different example. Now come back again to a short example. Let's suppose that, you know that when you do electric wiring, what do you do? On the walls, what do? They make some drilling, they make some lining like this, okay? They, some kind of holes they put in the walls in which they run the electric cables. So the first step is you put holes in the wall. And the second step is that you run cables. And the third step is that you attach switches or electric, whatever, gadgets, whatever. You attach gadgets. So you invited me in to do this wiring, electric wiring for you. I dig the holes in all of the walls. And then you say, Mr. Ali, please stop it. I don't want to continue. So you should be giving me money for this thing. Or I should be asking you money. Maybe I said I'm not doing further because I have given you, this is a separate performance obligation because you will get benefit out of it. Because next time when you will invite someone, they don't have to dig the holes. Holes are already there. They will only run the cables. So it has some value, okay? This work, it does have some value. Okay, these are the two examples. Now see one more example. Let's suppose that this is a wall on which I need to put wallpaper, okay? So you know that how do you put wallpaper? First you spread the glue on the wall. So you put glue and you spread it everywhere on the wall, the glue. And the second thing is that you put papers, okay? You put wallpapers. Now let's suppose I come in and I glued the wall. I put the glue on the wall. And then I say, Majish, I'm sorry, I'm not doing, I'm leaving. Please give me money for putting the glue on the wall. please give me money for putting the glue on the wall. Do you think I am entitled to some money for putting glue on the wall? Does that make sense?
No.
Huh?
I think no.
Certainly not. It is actually one part of the job. Just like these are three parts of the job, this is also a part of the job. But in its individual capacity, it is of no use, because the glue which I have put in 1 hour, it will become dry. And the next person who will come in, he again will have to put the glue. I cannot say that this service which I have provided you is of some benefit to you. You can use it, you cannot use it. So this is not a performance obligation. So remember that any part of the service which has a separate price, which has a separate market price, like if I ask someone in the market, what is the price for putting holes in the wall? They would say, $2 per running meter. What is the cost for putting cables? Maybe $2 per running meter. What is the cost of attaching a electric lamp or something or switch? They would say $1 per switch. So these have separate prices in the market and they have separate usage. But you cannot ask someone that, okay, I want to put wallpaper. Tell me what is the price of putting glue and price of putting the paper. It has just one price. So although these are two activities, but they cannot be priced separately because it does not have any benefit separately. So a performance obligation should be something or is something which has a separate identifiable price in the market, which can be sold separately in the market, from which someone can get benefit, or either they can use it, they can keep it, or they can benefit it for somehow. That is something which you call performance obligation. So when you sit down now, and you are thinking about your building and you are thinking about how many performance obligations should I have, you think about that, how much small elements you can make which are separately identifiable. So these are called 5-step approach. This is the 5-step approach of your IFRS 15. Identify the contract, identify the performance obligation, identify the contract price, and then allocate the contract price to performance obligations, and then finally recognize the revenue as performance obligations are satisfied. So next step is explaining these ones. Step 1, features of a contract under IFRS 15. Contracts and approval of contracts can be written, oral, or implied. It could be written, could be oral, could be implied, assumed by an entity's customary business practices. So it depends on how do you make contracts. Sometimes it is very formal. Sometimes you make someone a call, please deliver this thing to me. That's a verbal thing. Or maybe it is assumed, you have a guy who delivers newspaper every day to your door. You don't call him every night, but he brings the newspaper every day because it is implied that you need it every day. And he has been doing it like this in past. So one morning he comes and throws the newspaper. You cannot say that I didn't ask you, because it was implied contract. The contract has been IFRS 15 requires contracts to have all of the following attributes, all of the following. The contract has been approved. The rights and payment terms regarding goods and services to be transferred can be identified. What are the rights and payment terms? The contract has commercial substance. It's very important. It's very important. You cannot have a contract with zero value. Okay. If there is a contract in which party A delivers something, maybe delivers some goods or maybe delivers services, and party B does nothing, there is no contract. There is no binding contract. It could be some kind of favor or some kind of social obligation, but it does not have any legal binding capacity because it must have some commercial substance. Commercial substance means that there should be some price. Okay. Either in terms of cash or in kind. Maybe if you don't want to, if it is not in cash, maybe in return they can give some services, they can give some debt, assets, or they can waive off some liabilities, etc. So it should have a commercial substance. And that is why many times you people have heard that someone works for some company and gets $1 salary. Something like this you might have heard many times. Oh, he gets only $1 salary, because they want to put a commercial substance on the contract so that the legal binding thing should be there. So you would never see that, okay, I'm working for free. If you want to work for free, take $1, but you must take something. Or maybe you take not $1, but in return, you take some other facility, some other benefit. Then it is probable that the consideration will be received, considering only the customer's ability and intention to pay. That's very important. Okay, we discussed this thing before as well, that for contract under IFRS 15 revenue, the customer should have the consideration is there, and it is probable that consideration will be received, which means that the customer has the ability to pay and willingness to pay. Because sometimes you will see in a question statement, in a scenario, in exam scenario, that the customer does not have the capacity to pay, or the customer is suffering from some kind of financial difficulties. So for revenue, it is important, because I'm going to book it as my revenue. I'm going to tell it to my shareholders. If there is no possibility of getting the money, why should I tell my shareholders that I have this revenue? And if each party to the contract has a unilateral, that's also interesting. If each party to the contract has a unilateral, which means one-sided, enforceable right to terminate a wholly unperformed contract, without compensating the other party. No contract exists under IFRS 15. The contract might exist under some individual law regimes. It might exist under UK law. It might exist under Indian law. I'm not going into that detail. I'm talking about IFRS 15. IFRS 15 will not consider it as a contract, which means that one party which has a right to terminate the contract. Like I can terminate the contract just from my side, without asking you, without taking your consent, just unilaterally, single-handedly, I just terminate the contract, and without compensating the other party, and I don't compensate you. So it means that actually this contract does not protect your rights. We know that contract must have rights and obligations of both parties. So it should be like, a contract must present the rights and obligations of both parties. In such situation, only one party has some right, but they don't have obligation, and the other party does not have any right. So this is not a contract under IFRS 15. Step number 2, combining multiple contracts.